Imagine a network, right, capable of processing 100,000 transactions per second.
Which is just a staggering number to even visualize.
Yeah, exactly. To put that into perspective for you, that is over 4 times the maximum capacity of the entire Visa global payment network.
Right.
And here's the hook. Imagine that the native token powering this absolute beast of the financial engine is currently trading for like roughly half a penny.
Oh, yeah.
All while the broader financial world is just gripped by this cascading global geopolitical panic.
It creates one of the most fascinating disconnects you can find in the current data. I mean, you have this towering, provable technological achievement colliding head-on with, well, absolute raw macroeconomic fear.
Right. So welcome to the deep dive. Our mission for you today is to sift through a massive, heavily detailed stack of sources.
And it is a stack.
And we're talking crypto market analysis, technical protocol white papers, and internal exchange data from MEXC and Binance.
All stemming from late March and early April of 2026.
Exactly. And we are looking specifically at a project called Onyxcoin, or XCN.
The timing of this data stack is it's critical to everything we're going to discuss today.
Yeah.
Because on March 27, 2026, Onyx Protocol launched their highly anticipated Goliath mainnet.
But they launched it into a climate that the Global Fear and Greed Index is classifying as extreme fear.
Right, due to the heavily escalating conflict between the U.S. and Iran.
It is basically the equivalent of launching a state-of-the-art supertanker right into the teeth of a Category 5 storm.
That's a great way to put it, yeah.
So here is our roadmap for you today. First, we're going to understand the mechanics of this Goliath tech upgrade, moving past all the buzzwords.
Right.
Second, we'll look at the XCN token itself, because its utility and the governance model are completely transforming.
Completely.
Third, we're going to examine the institutional endgame, because, 100,000 transactions per second isn't built for retail meme coin trading.
Definitely not.
And finally, we will decode the complex technical charts to figure out if this is, a sleeping giant or simply a sinking ship.
Yeah.
Okay, let's unpack this. Let's start with the Goliath leap itself. What are we looking at here?
Well, to understand the sheer magnitude of the March 27th launch, we really have to look at the architecture Onyx was using prior to Goliath.
Okay.
They were operating as a layer 3 application. So essentially, their infrastructure was built on top of Arbitrum and Base layer.
Which themselves are built on top of the Ethereum base layer, right?
Exactly.
I look at that layer 3 model like being a highly successful boutique renting space inside a massive, heavily trafficked shopping mall.
Oh, that's interesting.
Yeah, you get the benefit of the existing foot traffic and, the mall's security guards, but you don't control the operating hours. You can't set the rules for the other stores, and you are entirely at the mercy of the landlord when it comes to rent.
Which, in crypto terms, is gas fees. That is a perfect way to visualize it. And the Goliath mainnet launch was Onyx deciding to, pack up that boutique, buy their own massive plot of land, and build a sovereign, high-speed financial district from scratch.
Wow.
Yeah, they transitioned away from being a dependent Layer 3 application into a fully sovereign Layer 1 blockchain.
And the specs on this new financial district are just breathtaking. I mentioned the 100,000 transactions per second in the intro.
Yeah.
But the metric that really jumped out of the technical white papers to me wasn't the throughput, it was the finality.
Yeah.
They were citing 1.2 second block finality.
Yeah, and what's fascinating here is that this specific technical architecture isn't just about raw speed.
Yeah.
It's about deterministic finality.
Meaning what, exactly?
Well, in the traditional finance sector, if a multinational bank is going to use a blockchain to settle, say, a $2 billion cross-border payment,
Right.
they cannot afford a probabilistic system where that transaction might be reversed, delayed, or reorganized just because the network suddenly got congested by a new NFT mint.
Oh, absolutely not. They need that $2 billion mathematically set in stone immediately.
Exactly.
I want to try to break down how they actually achieve this, because the sources point to a consensus mechanism called asynchronous Byzantine fault tolerance, or ABFT.
Right, ABFT.
My understanding of standard blockchain validation is that all the nodes basically have to wait in line to agree on the state of the ledger at the same time.
That's synchronous, yeah.
But the asynchronous part of ABFT means these nodes can communicate and process data independently, right? without waiting for the rest of the global network to catch up and sync simultaneously.
You've hit on the exact mechanism that makes this work.
Right.
Traditional synchronous networks bottleneck because they are only as fast as their slowest connection.
That makes sense.
With asynchronous Byzantine fault tolerance, the nodes process batches of transactions independently, and then they mathematically prove the validity of those batches to the network.
Oh, wow.
Yeah. And even if, let's say, up to a third of the nodes on the network are acting maliciously or
if a major internet cable gets cut and a whole continent of nodes goes offline.
Exactly. The ABFT algorithm guarantees that tamper-proof fair transaction ordering continues.
That is wild.
It ensures that once a transaction happens, it is permanently, irreversibly locked into the ledger within that 1.2 seconds.
And they didn't just build the back-end engine, right? The sources emphasize the front-end user experience as well.
Yeah, they did.
The Onyx app launched alongside the mainnet with native support for the entire ecosystem. You can bridge your assets directly between Ethereum and the new Goliath chain.
Right.
You can instantly swap XCN, Ethereum, and USDC all in one interface. It's like they've built the high-speed roads, the banks, and the currency exchanges concurrently.
It's really all about removing user friction. By housing the bridge, the decentralized exchange, and the staking mechanisms natively within the Onyx protocol, you prevent value from leaking out to third-party applications.
Okay, so now that they own the land and aren't paying rent to Ethereum or Arbitrum, they get to entirely define the economy of this new sovereign city.
Yeah.
Which transitions us directly into the changing role of the XCN token itself and the governance revolution they just pushed through.
The shift to Layer 1 fundamentally redefines XCN. Previously, it served almost exclusively as a governance token.
Like you just held it to vote on protocol changes.
Exactly. But on the Goliath network, XCN takes on a triple asset utility, and the most critical being that it is now the native gas token.
So to do anything in this new financial district, execute a smart contract, send a payment, mint an asset, you have to pay the network toll in XCN.
Yes, and the economic design dictates that a portion of every single XCN transaction fee is permanently burned.
Okay, creating a constant deflationary pressure.
Right, because if this network begins processing even a fraction of the 100,000 transactions per second it's capable,
Yeah.
the sheer volume of XCN being permanently removed from the circulating supply becomes a massive structural shift.
It effectively eats its own supply to secure the network.
That's so interesting.
And the sources also highlight a major change to staking. They introduced a liquid staking model offering a 25% yield.
Right.
But what stood out to me is the liquid mechanism itself. You aren't just locking your tokens in a vault and watching a number go up. When you stake your XCN, you receive a receipt, token, STXCN in return.
And that receipt token is the key to capital efficiency.
How so?
Well, in older staking models, locking up your assets meant you couldn't use them anywhere else.
Right, they were stuck.
With liquid staking, you can take that STXCN receipt token and deploy it elsewhere in the decentralized finance ecosystem.
Oh, okay. So I could use it as collateral to take out a stablecoin loan.
Exactly. All while your original underlying XCN is still safely compounding that 25% yield on the back end.
Okay, here's where it gets really interesting. Because the tokenomics and the liquid staking are just the economic engine. We have to look at who is actually sitting in the driver's seat.
Right, the governance.
Let's dig into OIP 56, the Onyx Improvement Proposal 56.
This represents a massive governance overhaul. Prior to OIP 56, the barrier to entry for shaping the protocol was exceptionally high.
Yeah.
If you wanted to submit a formal proposal to change the network, you were required to hold 200 million XCN.
Which, even at a half a penny per token, 200 million XCN is $1 million.
Yeah.
That completely prices out the vast majority of the community. Plus, because they were previously operating in an Ethereum-dependent ecosystem, you had to pay actual Ethereum gas fees just to cast your vote on other people's proposals.
It was a system that centralized power by default.
Right.
But OIP 56 completely restructured that dynamic. First, it slashed the proposal threshold from 200 million down to 10 million XCN.
Yeah.
Second, it transitioned the voting process to snapshot.
And just to clarify for you listening, Snapshot is a massive deal because it makes voting entirely gas-free.
Yes, totally free.
Instead of forcing you to pay a blockchain transaction fee every time you vote, Snapshot simply takes an off-chain picture of the blockchain at a specific block height.
Right.
It reads your wallet balance, verifies your voting power, and lets you sign a cryptographic message off-chain to cast your vote. No transaction fees required.
And the removal of that friction point is essential for voter turnout.
Okay, but I have to push back on the proposal threshold for a second here.
Okay, go ahead.
I was running the numbers on this while reviewing the notes. Lowering the requirement to 10 million XCN means you still need roughly $50,000 worth of the token to submit a proposal.
Yeah.
So does a $50,000 cover charge actually democratize this platform for the everyday listener? Or does it just allow mid-sized whales to wrest control from the mega whales?
It's an important critique, honestly. And you're right that $50,000 is not a grassroots one vote utopia.
Right.
However, in the context of securing a blockchain design for billions in institutional volume, you have to balance accessibility with civil resistance.
Civil resistance.
Yeah, preventing bad actors from spamming the network with malicious proposals.
Oh, I see.
By lowering the threshold to 10 million, the data shows over 160 different wallets now mathematically qualify to initiate early-stage polling.
So it significantly broadens the boardroom, even if it doesn't open the doors to the general public.
Exactly. You are decentralizing power away from a tiny concentrated oligarchy to a much broader base of highly invested participants.
Right.
When 160 independent entities can suddenly propose protocol upgrades, structural marketing initiatives, or deep tokenomic tweaks, you force a do-something moment.
Okay.
It shifts the community psychology from passive observation into active competitive participation.
That structural alignment is fascinating. You have a highly engaged, decentralized boardroom, a deflationary token model, and a sovereign network processing 100,000 transactions a second with absolute finality.
Right.
If you look at those components together, the obvious question is, what is the actual target market here? Because you don't engineer that level of deterministic finality just to make retail trading faster.
You really don't. The target audience for the Goliath architecture is purely institutional. They are aiming at global banks, enterprise-level supply chain managers, and Wall Street Treasury departments.
The white papers in our source stack explicitly highlight target industries like cross-border interbank settlements, real-time healthcare audits, and massive supply chain verification.
Yeah.
These are the logistical backbones of the global economy.
If we connect this to the bigger picture, traditional finance is acutely aware that their legacy systems like the SWIFT network, which can take days to clear international transfers.
Right, so slow.
It is archaic compared to distributed ledger technology. But institutions have non-negotiable requirements before they can migrate.
What kind of requirements?
They demand predictable sub-penny transaction costs. They demand the deterministic finality provided by ABFT. And most importantly, they demand regulatory armor.
And the regulatory element is a massive piece of the puzzle for Onyx. The sources detail their aggressive focus on U.S. regulatory compliance.
Yes.
Specifically securing a classification under the U.S. Clarity Act as a digital commodity token.
That classification is the prerequisite for adoption. Imagine you are a treasury manager at a major U.S. bank.
Okay.
You cannot, under any circumstances, allocate billions of dollars of institutional capital into a protocol that the SEC might arbitrarily classify as an unregistered security tomorrow.
Right. That's way too much risk.
Exactly. The Clarity Act classification provides the legal green light for traditional finance to engage with the XCN token without fearing sudden enforcement actions.
The fascinating part is that this institutional appetite is already showing up in the market data. You just have to know where to look.
Yeah, the Binance report.
Right. Our source stack included a deep dive Binance OTC report from early 2026. It revealed that institutional trading volume surged so violently that it reached 25% of the entire 2025 trading volume in just the first 2 months of 2026.
And the operative term in that report is OTC, over the counter.
Right.
When a major institution decides to accumulate $50 million of a digital asset, they do not open a public exchange account and click market buy.
Because doing so would cause massive price slippage. They drive the price up against themselves with every block they bought, alerting the entire retail market to their strategy.
Precisely. They utilize over-the-counter desks to execute these massive trades directly with other large holders, completely off the public order books.
No.
Institutions want invisible crypto. They want incredibly deep liquidity and rapid settlement without triggering retail volatility.
And the Goliath network is built for that.
Custom built for it. With its massive throughput and compliant architecture, it functions as the settlement layer for this exact type of discrete, high-volume capital movement.
So let's look at the board. We have this beautifully engineered sovereign financial district. The zoning laws are regulatory compliant. The technology is undeniably world-class. The boardroom of 160 wallets is activated. And the institutional capital is quietly accumulating in the background.
Right.
Which logically leads us to the core contradiction in all of our data.
The market reality.
Exactly. If the Goliath mainnet is a technological marvel, and our sources verify the tech is fully operational, why is the XCN token trading between 0.000047 and 0.0053?
It's a great question.
It is down 62% from its January 2026 highs. If this protocol is a sleeping giant, why is the market ignoring it?
To understand the price action of XCN in April 2026, you cannot look at the Onyx ecosystem in isolation.
Okay.
You have to zoom out to the macroeconomic landscape. The broader cryptocurrency market and global risk assets in general are currently paralyzed by extreme fear.
And unlike previous cycles, it's not a localized crypto scandal causing the fear, right? It's raw global geopolitics.
Exactly. The geopolitical conflict between the United States and Iran has escalated to a point that is triggering a massive flight to safety across all global markets.
Yeah.
We're seeing oil prices spike aggressively, which immediately resurrects inflation fears for central banks.
Right.
At the same time, emerging market currencies are buckling under the pressure. The South Korean one, for example, just hit a 17-year low.
When the global economy feels like it's standing on the edge of a cliff, institutional hedge funds do not allocate capital to mid-cap alternative cryptocurrencies.
No, they don't.
They rotate heavily into the US dollar, they buy gold, or they retreat entirely into short-term treasuries.
And XCN is what quantitative analysts classify as a high beta asset.
High beta.
Yeah, beta is a metric that measures how aggressively an asset moves in relation to the broader market index, which in crypto is Bitcoin.
Okay.
If Bitcoin catches a cold and drops 5% due to macro fears, a high beta asset like XCN catches pneumonia and drops 20%.
Oh, wow.
The underlying technology of Goliath simply doesn't matter when the overarching algorithmic trading models are set to risk off and indiscriminately selling.
But the sources also provided some incredibly detailed technical analysis on the XCN chart specifically. And the indicators they are watching tell a very compelling story.
They do.
Let's look at the Connors RSI, or CRSI.
The Connors RSI is a sophisticated momentum oscillator. Unlike the standard RSI, it blends three separate components: momentum, duration of the trend, and rate of change to find extreme market imbalances.
Right.
In April 2026, the CRSI for XCN is sitting at an incredibly low 29.99.
And anything under a 30 on the Connors RSI signifies that an asset is deeply, fundamentally oversold.
Exactly.
It illustrates momentum exhaustion. Basically, the geopolitical fear has wrung the market dry. Anyone who is going to panic sell their XCN has already done so.
It doesn't guarantee an immediate upward reversal, but from a statistical standpoint, it suggests the downside risk is largely depleted. The selling pressure has capitulated.
But the absolute standout indicator from the technical analysis notes is the Williams alligator. I love how technical analysts lean into these vivid biological names for complex mathematical formulas.
Yeah, it's an incredibly descriptive indicator created by Bill Williams.
Right.
And it relies on three separate smooth moving averages calculated over different time frames, which he named the jaw, the teeth, and the lips.
And right now, according to the Femex market analysis and our sources, those three moving averages have entirely converged. They are resting right on top of each other. In technical analysis parlance, the alligator is sleeping.
When the alligator's moving averages converge, it visually represents an extreme compression of market volatility. The market is moving sideways, entirely devoid of a trend.
It's like two massive tectonic plates locking together. On the surface, the chart looks completely flat and boring. But underneath, the kinetic energy is building to a breaking point.
That's a great analogy.
The sleeping alligator indicator doesn't tell you whether the eventual earthquake is going to drop the floor out or shoot the price to the moon, but it mathematically guarantees that the period of low volatility is about to end violently.
And this raises an important question. When that volatility finally returns and the energy is released, what are the realistic upside targets?
Which brings us to the ultimate retail investor question we saw plastered all over the community forums in the source material. Can XCN hit $1? Everyone loves the psychology of a clean $1 target.
The psychology is powerful, sure, but we have to ground those expectations in mathematical reality.
Right.
With a circulating supply of roughly 37.8 billion tokens, a $1 price point means the Onyx protocol would command a $37.8 billion market valuation.
To put that into market context, a $37 billion valuation would catapult Onyx into the absolute upper echelon of the global cryptocurrency rankings.
Yeah, it would.
It would put them shoulder to shoulder with the all-time peak valuations of massive decentralized finance giants like Uniswap or AIV.
Is it theoretically possible in a multi-year time frame? If they successfully capture a significant percentage of global interbank settlement volume, yes.
Okay.
But is it a realistic, actionable target for the 2026 cycle? Absolutely not. Assuming a $1 target requires ignoring the current macro environment entirely.
I see. The only mechanical wildcard would be the token burn we discussed earlier, because the Goliath network burns XCN with every transaction. If institutional volume floods the network, that 37.8 billion supply begins to shrink rapidly, which fundamentally changes the valuation math.
That deflationary mechanic is vital long-term. But without years of aggressive supply burns, the market analysts and our sources point to much more pragmatic targets.
What are they looking at?
If the geopolitical tension cools off and the Goliath technology begins handling the invisible OTC volume we discussed, realistic upside targets for late 2026 sit between 0.005 and 0.112.
So what does this all mean? Let's synthesize the moving parts for you.
Okay.
Onyxcoin has just successfully delivered a monumental structural technical upgrade. Their Goliath Layer 1 network is fully live.
Yep.
It boasts transaction speeds that dwarf Visa. It utilizes an asynchronous consensus model to guarantee deterministic 1.2-second finality, and it operates under a newly democratized governance structure where 160 different wallet groups actively steer the network's future.
Yet, despite that fundamental technological triumph, the asset is currently trapped by severe macroeconomic headwinds.
Right.
It's absorbing the bleeding from global geopolitical fears, waiting in a state of extreme volatility compression for institutional adoption to validate the technology and wake the sleeping alligator.
You essentially have a sovereign economic engine, fully capable of running the back end of global finance, and the native currency required to operate it is trading for a fraction of a penny.
I think the most crucial dynamic to watch going forward isn't the daily XCN price chart or even the geopolitical headlines. No, it's the silent infrastructure upgrades happening inside legacy banks.
What's the hidden angle there?
If an open, decentralized ledger like Goliath eventually proves capable of securely settling the massive daily volume of traditional global banking, we have to ask who actually holds the power in the 21st century.
Okay.
Is it the traditional nation states and central banks printing the fiat currency? Or is the ultimate geopolitical power slowly shifting to the 160 anonymous wallets that govern the protocol's routing algorithms?
Wow, that is a staggering thought. The power doesn't lie in the money itself, but in the entities controlling the unalterable tracks the money runs on.
Exactly.
We will definitely be keeping a close eye on that shifting dynamic and, of course, that sleeping alligator. Thank you for joining us on this deep dive. Keep asking questions, keep looking past the obvious headlines, and keep exploring. We'll catch you on the next one.